Guys, it's Steve Currington, mortgage banker, and I want to talk to you today about the CFPB. That's the Consumer Financial Protection Bureau. Now, this was a bureau that came out of the Dodd-Frank Act 2011-12 era when we had the giant mortgage meltdown that happened across the nation. And recently, a lot of things have been happening. Now, the CFPB, in case you didn't know, I feel like their entire goal is to go out and fine banks and mortgage companies for doing things wrong, which is more regulation, which hurts those companies. It costs them lots of money. I think 80 or 90% of their budget comes from fines and levies against different lenders or mortgage companies or banks. So now that this new administration's come in, it's now February of 2025, and it looks like it's getting shut down. It looks like they're sitting on roughly $800 million and have said that they don't want any more money coming in the next quarter. And they've basically sent everyone home and told them to cease operations unless it's just the minimum things that have to get done. So they're not going after anybody, they're not chasing anybody, they're not finding anybody right now, which is great. What this means for you is potentially lower mortgage interest rates, because as a mortgage company, as a lender that's trying to operate on a daily basis, regulation is a big piece of that, and it costs a lot of money. And mortgage companies out there are going to be more likely to do different things to be able to cut their cost. I mean, compliance alone is a very big expense that you have as a mortgage company. And I'm not saying this might be immediately, but this is a step in the right direction to try to get regulation down so that people can run their businesses and not in fear of the government coming and slapping you with a big fine that you have to pay. And as a result, I think you might see some lower mortgage interest rates. So stay tuned for that.